Hey guys, Ben with Income Options Trading here. I just want to do a quick video on why short puts can be so versatile and how they can be synthetic covered calls as well. So a quick disclaimer here that options trading involves risk and you and only you are responsible for the trades you put on. So make sure that you understand the risks of option trading before you put on any trades. So this case study here is an actual trade I put on in Zillow, which is Z. So I put the trade on initially November 2nd. This was right before earnings was reported, and Zillow came out and said that a bunch of houses they bought they had to foreclose on because the market went sour. So I'm using Tastyworks here, and Tastyworks has a pretty nifty chains tool. So you can see my initial trade I put on here on November 2nd. It's a 70 put with the November 19th expiration, which was a 17 DTE. I put this on right here when the stock was just above $85, so 86 something. So I thought, 70 put that I had a lot of room. Well, gap down the next day from earnings, so that didn't go so well. So I ended up rolling the next day, and I just kept rolling the 70 put just further and further out in time. So you can see here I put arrows. This is where I put on each of the trades or rolled the trade, and I put the break-even price, which is the 70 put less the credit I received. So I received 119 the first trade, and then 152 for the next roll, 57, and so on and so forth. And so far to date, I've taken in $6.79 of credit. So basically, my cost basis, if I were to get assigned on the shares here, would be $6.79 less than 70, which I have here at $63.21. So you can actually see that Zillow is $65, so I'm actually above break even. So on the chains tool here, this is my total P&L right now. I'm still down on the trade about $400, and the reason that is my my short put is 94 DTE, so there's a lot of time left in this trade yet. But so for the short put, I put on when it was $86. I like to sell short puts if I want to get assigned, and then if the stock goes below it, I like to keep it kind of where it's at. And when that happens, it's basically a covered call. So my position right now is the same thing as buying 100 shares of Zillow at $65 and then selling the 70 call. And so I still have $5 to go from 65 to 70, so that's $500 that I can make yet on this trade, just from the stock portion. And then I have the extrinsic value portion that if I go back here into the option chain May 20th, you can get the extrinsic value by basically looking at the opposite option price. So for the puts, to get the extrinsic value, I can look at the calls. So I'm looking at 590 or so in extrinsic value. So if that washes out, I have that potential to make yet. So you can see I have a standing order in for 610, and that will yield me about $60 in overall credit. So I need Zillow to keep going up, and that's what it's looking like. So if I would have just bought the stock here at $86, I would be down about $2,000. But since I sold this short put, and I've rolled it several times, and the stock has rallied, which is what I want with a short put, I'm only down about $400 so far. And if Zillow stays right here, as long as it's above this 63.21 in 90 days, I'll make money. So I like that as well. Let's see. Anything else I want to touch on? Here, position tab. This is the delta of the position. So I'm at just about 53 delta. So like I said before, the short put is synthetically a covered call. So if I were to buy 100 shares of Zillow and then sell the 70 call, that is a 46 delta. So my 100 shares would be positive 100 delta. And if I were to sell this call, it'd be minus 46 delta. So net, my position would be plus 54 delta. And that's basically what I have here, plus 53 delta. So with a short put, once you go in the money, I like to roll if I can get a credit. And that's why I rolled each time. This 57 cents here, that was probably as low as I would go. If it was below 50 cents, I probably wouldn't have rolled it, or I would have waited and maybe taken assignment. But I like to roll as much as I can when I'm taking credits because that lowers my cost basis. And it's the same thing as taking the shares and selling a call against it, but it usually takes less margin or capital. So my capital requirement for this is $2,500. So if you do a cash secured put, which a lot of people like to do with the wheel strategy, that would take up $7,000. If you were to buy the shares, Tastyworks gives you 2-to-1 margin, so it would take up about $3,500 in capital requirement. So the short put is less capital up front compared to those two. So that's why I like to roll the short put as much as I can. And if Zillow were to go down and stay in the 50 range, I would continue to roll this out in time as long as I can get a decent credit. And hopefully I don't get assigned. Another thing that I wanted to touch on is, I didn't get assigned even when, the stock was down here and at 53 and even down here at 45. A lot of people think, oh, I'm at the 70 strike and I'm $25 in the money. I'll get assigned for sure, but assignment happens or exercise usually. People would exercise if his extrinsic value was next to nothing. So right now my extrinsic value is $583. So people wouldn't assign this. Back when it was back in here on the 23rd, my extrinsic value, this one here, might have been $100 or $1. And people don't want to just burn that. So if you get assigned, it's not a bad thing because whatever that extrinsic value, you're getting that in your pocket. So that's another thing. Don't be afraid of assignment. That's good. If I were to take assignment, then I would just do an actual covered call and I would just sell the 70 call and it'd be the exact same position. So that's all I wanted to really touch on today. If you have any questions, leave them in the comments. Any suggestions for future videos, I'm all ears. So hopefully you guys enjoy this, and I'll see you next time.